And good morning. Welcome to another episode of Money Matters. My name is Nev. We're broadcasting live only here, only on onedealaway.com. And I am beyond excited to be here with you. Of course, Charles has joined the show as well. So he is here, ready to go, ready to learn. I hope you are as well, because we have a very good episode today. We're going to be covering a little bit about what's going on with markets, what the prices are, what the futures are for today, and what you can expect to potentially see inside the market. And then, of course, we're going to see some news around the world of what's been going on, anywhere from unemployment, of course, looking at a bit of charts from the Fed to understand a bit better about what's going on. And that's going to be a really, really fun show. I think we're going to be uncovering a lot of things of, some of the plants closing, expectations for travel and tourism. So if you're in a tourism industry, what can you expect that you will be able to see when we get, as the year progresses and towards when we get towards the end of the year. So I hope you're excited. Welcome to the show, and let's do this. And good morning, good morning, good morning. What a beautiful Friday morning is. I am beyond excited for the things I get to do today. I hope you are as well. So here we go. We're going to get started a bit with what's going on with Renault. So Renault is actually announcing 15,000 job cuts worldwide, y'all. 15,000. So as you know, it's a French car maker, and they've been struggling for a little while. And they have just announced that they are cutting 15,000 jobs worldwide as part of their $2 billion, 2 billion euro. My apologies. Cost-cutting plan over 3 years. Nearly 4,600 jobs will be cut in France, and more than 10,000 in the rest of the world. Capacity will be revised from 4 million vehicles in 2019 to 3.3 by 2024. So they're looking to sort of lower the production so that they can increase productivity and, of course, profitability. And, it sounds like the needs are not necessarily as high as we once wanted and needed and desired. So they are adjusting what they're doing. But, of course, that means that they're going to be losing quite a bit of jobs. They employ 180,000 workers worldwide, and they have announced the suspension of plant capacity increase project in Morocco and Romania, considering adaptation of its production capacities in Russia, and announced a halt of Renault branch oil-powered car activities in China. As you can see, they are definitely a global company, and they're cutting things everywhere. Close to one site in France, and 13 other sites in France will sort of shift kind of what they're doing and what they're working on, including working on electric vehicles, light commercial vehicles, and high value added innovation. So its alliance with Nissan and Mitsubishi is a global auto player, but has been struggling since 2018. So there was news, I want to say yesterday, day before yesterday. We didn't cover it here because there's only so much you can cover, right, in a short period of time. But there was they had talks between Nissan and Renault of kind of how they're going to move forward as sort of partners. Do I expect potentially some mergers and acquisitions? Anything is possible in today's day and age. French government is the single biggest shareholder of Renault with 15% stake. So if you watch the episode, was it yesterday, day before yesterday? Days are starting to run together. But recently we did the thing where Lufthansa, Germany owns about 15%. It can go as high as 25% of Lufthansa. You can see that Renault, his biggest shareholder is France. So we're seeing this all around the globe, and we haven't seen this as much in the United States, but it's starting to happen. We're starting to see some of that stuff happen where the countries are buying their stocks and bonds and doing all these different things, and they become basically shareholders. And technically, if you really think about it, that means that the company is going from public to nationalized, because when you have such a large shareholder, they get to tell you what to do more than just sort of government laws and rules and that kind of stuff. So while Renault is cutting billions in costs, Volkswagen is investing 2 billion euros or $2.2 billion to expand its presence in China's electric car industry. Something very interesting to think about. You have one company cutting, another one is sort of boosting, and it's a big world. It's a pretty big world, and so you kind of play the game of like, what is my competition doing? Where are they? Where they're not? If they cut here, maybe we're going to go there to capture more of the market. So it's definitely an interesting game. It's kind of like a game of risk that we all seem to be playing right now. But it's time to change over to what's been going on with the initial unemployment claims. And here's a graph straight out of Fred, which is the Federal Reserve out of St. Louis. Of course, you can do your own research over there. And you can see over here, here is kind of what the initial unemployment claims have been since like the 60s, right? The earliest one is in 67. The gray things, again, a reminder, are the recessions. And we've seen sort of these minor bump, 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 bump. And you will notice that the biggest bump is at the end of a recession, not at the beginning. And so that actually makes me question of what's been going on, because you look at this stuff over here. Take a look, y'all. It's sort of like, and then boom, there's this giant thing. So let's zoom in and click on 1 year, and you will see it's been staying pretty steady, pretty steady. And then we just had this giant thing that kind of bumped up, and now we're starting to sort of slow down. But you are noticing that companies are still just now announcing cuts, anywhere from Uber to Renault to some other companies around the world, big, small. We're seeing, I was going to say foreclosures, but yeah, we're going to see foreclosures as well. But we're seeing bankruptcies. So we're seeing a lot of different things that, I don't know that this is necessarily going away. So these are just initial claims. This does not take into the account people that have attempted but were not successful, people that don't qualify, people that haven't tried, and people that are continuously on it. And as of today, and today is May 29th, my goodness, summer is here, y'all. Summer is here, y'all. Uh, we are well over 40 million people in United States alone. In United States alone. But there is a bit of news that there is around 2 billion people that may lose their jobs in the next couple of months due to pandemic. And of course, this is being basically written today, so this is fresh off the press, as they call it. 2 billion people. There is what, 7 billion people in the world. That's like a third of the world, y'all. Okay, it's a little bit less than a third, but it's definitely more than a quarter. So for those of you that are like math aficionados, go ahead and calculate it. Let me know in the comments in the chat of what do you think it is. But that's just a lot of people, y'all. That's a very, very large number. More than half of world's workforce, nearly 2 billion people, risk losing their job or moving to part-time work in 2020 as a result of the economic fallout from coronavirus outbreak. That's according to a study by the Boston Consulting Group. And so, they're basically looking at it and saying, we are expecting a lot more people to lose jobs. In the next 2 to 3 months, 1 out of 6 people in the world will lose their job, with unemployment rate expected to exceed 17%. Um, so this is the crazy piece. They were like, unemployment rate to exceed 17%, but then you say more than half of the world's workforce. So I'm not quite sure what happened here. Maybe I'm not understanding what they're trying to say, but maybe this is the additional 17% over the couple of months over the summer. So I don't know. But he's basically saying that the impact on the crisis on the labor market will vary greatly across industry, with those most directly affected by quarantine measures to be hit the hardest. Of course, more than 80% of all layoffs in the world are likely to occur in the non-food retail sector, manufacturing, hotel and restaurant business, tourism, and construction. And I mean, I agree. I don't think we looked at yesterday of sort of the travel patterns from TomTom. You can do the same thing. That lets me know, and that thing hasn't improved throughout the different cities and states and countries as you take a look at it, even with the reopening. Yeah, you see traffic, but it's not what it was. We're seeing some of the restaurants open, but people are not wanting to go in. Been having a lot of conversations with folks. They don't want to go on a cruise. They don't want to go on a flight. They definitely don't want to stay in a hotel or Airbnb. So we're seeing all of those industries suffer in a big way. And yeah, I can definitely see the retails. I mean, you've seen them going from bankruptcy to bankruptcy. They're talking about malls opening. But when I talk to people, they don't want to go into malls. They don't want to go shopping. They don't want to try anything. And then, there were news from Levi Strauss, the famous jeans company, right? The Levi's 501. I remember when that thing was like super popular. Everybody had to have it. I was a teen, y'all. I was a teen and I begged my mother for one of those things, but eventually I got a pair. So thanks, mom. Um, but they were talking about, like what does it look like in today's day and age? How do you go and try clothes? And they were talking about like, they might have like a pair that everybody tries, and they have to like, I guess, Lysol it or spray it, or like if you try it, you might have to buy it. So it's definitely interesting stuff to kind of see what's going on. I don't know if you have been in the malls and kind of looked at that stuff. So let me know in the chat. Let me know in the comments of what's going on. I haven't been in a mall in ages, even before the entire closure. And, I don't plan to go anytime soon. I don't need anything. The minor few things that I need, I can order all online. And so, but, there we go. That's kind of where we are. And most of the stuff that I wear, as you can see, is my own sort of brand and my own design stuff. So I don't necessarily do the full blown retail shopping, but you might. So let me know, what does that experience look like? What does car shopping look like? When you go on a test drive, is it just you in the car? Is the other person there? And is everybody wearing a mask, or is there like a protective plastic shield? And like, do you feel comfortable sitting in the car, and how it is affecting it? So there's all these different questions that I think people have that I think is going to definitely affect all these different industries. And we're going to actually in a moment in the show, we're going to take a look at like what the impact is going to be on tourism this year because of the virus. All right, time for hydration. Mm-mm-mm. You gotta hydrate. You gotta hydrate. So we expect that the world's unemployment rate will start returning to balance by the end of 2020. However, the pandemic has already launched the process of long-term structural changes, from flexible and remote schemes to accelerated automation. And these changes will affect up to 1.5 billion jobs over the next decade. And I've been saying this for a little while that we're going to see higher amount of robotics. Interestingly enough, I want to say it was yesterday that I saw it. And again, I can't show every bit of news. It's impossible to do that and cover in a short period of time. But I saw this thing where, I don't remember who did it, and it was Scandinavian banks where actually they bought robots. And they're like the cutest little thing. They're about 5 feet tall or something like that. And they look like this, like the cutest little, thing that I totally would want to hang out with, or at least interact with. And what they did is they sort of set up the robot in one of their branches, and then they had the humans as well. And what they noticed is that overwhelming majority of individuals interacted and preferred to interact with the robots, not with the live human being. The only age range where they saw large number of people wanting to interact with the human being were people 60 and over. Everybody else, so 60 and under, they were going straight to robots, and they were basically saying like, we kind of trust it a bit more because they have these rules and stuff, and we don't know if they're, if the human is going to take advantage of us or not. And now with the disease and illness, like we don't want to interact with them, so robot just seems safer. And I think we're going to see more and more of that, from automation to online businesses to, people working remotely. I mean, you've seen a lot of companies that didn't think they can do remote business and remote work are doing it, and they're doing it incredibly successfully. And you know what? They are actually looking at the stuff and saying, my gosh, like we expect that, we have been actually more productive now than we have ever in the past. So if that sort of keeps true, we are beyond excited to keep this as is. And, you have that happening from, just about any sector that you can think about, from sales to technology, of course, to even education. In the world of education, a lot of things were very stagnant, but we're seeing a lot of schools, a lot of colleges picking up on the technology train, looking at creating virtual campuses, virtual student centers, virtual work, virtual front desk, virtual interaction. So the world of virtual is definitely picking up. And I don't see it stopping anytime soon. And so it's going to definitely be interesting. But they are basically estimating that by 2030, so less than 10 years, y'all, automation will put 12% of existing jobs at risk, and about 30% of jobs will require completely new skills. So this is one of those things that it's going to be very interesting. And I agree. I think that the world is definitely going to look different. Now, let's jump over and see what's been going on in the markets. And we can do that by looking at some charts. So, and then we're going to cover some additional news about the tourism and that kind of stuff that I promised you. So, real gross domestic product is basically sort of how well the company, how well the country is doing, and of course, because this is the Fed, we're looking United States, and this is basically kind of like what's going on. So this is sort of the baseline zero, and you can see that we are contracting, although it's not as sharp of a contraction as we've seen in some of the previous recessions. So again, this is just a Q1, and they're saying it contracted negative 5%. But again, we will see what that looks like because Q2 is we're still in it, so it's going to take a while. So when you look at this stuff, it's very historical in nature. It doesn't have ability to predict what the future is. I personally expect that it's going to go lower still. But again, I could be wrong. My crystal ball broke years ago, as I like to say, so I don't know. Here is the industrial production index, and of course, this has a large impact of what's going on with the sort of income, right, of the country. And so you can see that we have been doing pretty well. We saw contraction over in 2008, 2009, but as you can see, it was on a monthly basis. It was kind of contracting quite a bit. Now, this is since the 1920s. So let's zoom in just a little bit to make sense of this stuff. And, because I think you need to understand the gravity of what's going on. And look at this. We had a little bit of slump. We kind of climbed up and then just took a nosedive. And here we go. This was, February, March, April. Of course, May is not over, so they haven't reported it yet. And in case you want to take a look at sort of since, maybe we can put in since 2000 and let's do 2007 so that you really can take a look at what's been going on. Hold on. 2020. Come on. Update. No. No. Edit graph. Oh, now he's going to ask me all these different things. All right. We're not doing that stuff. I was hoping that one could easily change dates, because they put it over here and I haven't played around with it. I probably should have. My apologies. There we go. So you can see kind of how it was. We're not necessarily as low as it was in June of 2009. But again, this is not over, y'all. We're just, as I like to say, phase two of the whole thing. And so, we still have a bit to go. 10-year treasury, here you go. You can see this is, a few years sort of, you can see kind of how it's been going. And we have been falling down. We are basically, if we go on the annual basis, we are flirting between 0 and 1%, or actually, to be more accurate, between 0.6 and 0.8%. So it's kind of very much sideways move of what's going on in the bonds, but we'll be covering a bit more of what's going on, what you can expect. So here we go. Futures. Remember, I told you that futures often impact what happens during the day trading, and you can see the futures market, S&P, were actually turning a bit south. The same story kind of happens when we look at Dow Jones. You can see that it's going south, it's going down a few points. NASDAQ, pretty much the same story. So, we've seen some heat waves of what's going on in the markets. Now, please understand that the futures don't necessarily translate 100% into what happens during the daytime. However, it does influence it quite a bit, and there's a lot of sort of correlation between them. Gold, last time we looked at it, gold was sort of flirting between 17 and 1750. At that time, it was closer to 1700. Now we're actually kind of starting to climb up. Will it continue to climb? Will it not? We don't know that, but you can even see it here in the charts. Let's take a look at the silver because we haven't looked at the silver. This is not silver. Hold on. Let's take a look at the silver, please. Silver has been doing really well. There was a lot of people that were predicting that silver is going to go through the roof. As you may know, silver and gold are very much connected. And when one goes up, the other one goes up typically, not always. But silver tends to be much more volatile. So silver has been compressed for quite some time. And, last time we checked it, uh, for some reason, it's not showing the data. Come on. Yeah, I know the dates, but it's not showing the prices. All right, sorry about that. Let's take a look at the 1 month. So you can see, let's zoom out. Maybe that's part of the problem. We were zoomed in and you couldn't see it. So um, you can see it that it was very much down in the $14, $13, $14 level. And since then, we've climbed to over $18. So it's been performing, relatively speaking, well. However, you will see in February that we were at 19. So we still haven't recovered to the market that we were before. However, not many other things haven't recovered either, right? So, all right, let's take a look at the crude oil. Let me zoom in a little bit because we don't necessarily need to go all that much zoomed in, but it's much nicer to kind of see it. As you can see, the crude kind of had this slump. We performed nicely, and we're kind of hitting again, sort of in the bear territory. In the 6 month, you can see that we have been trending downward. Let's take a look at 1 year. If the computer door will actually play along. Come on, buddy. Work with me here. All right. Yikes. Give me max. All right. So you can see that it's gone down, but we've been sort of going a little bit sideways. So it's definitely going to be an interesting one to watch. And finally, last but not least, as they say, let's take a look at a Bitcoin and what's going on. Of course, I'm using Yahoo Finance for this. It's kind of lovely, I won't lie, that the Yahoo Finance is officially now listing Bitcoin so you can track it over there. This is not futures, this is live. As you know, Bitcoin is a 24/7, 365, 366 kind of market. So we've sort of seen a bit of a slump in the 8800s, kind of stayed sideways, had a nice little jump, had another nice little jump. We were well over, approaching 8600, and now we're sort of seeing the downward sort of slope. If we take a look at sort of 6 months, you can kind of see that we had the dump and we've been going trending up. And of course, if we look at the annual basis, we still haven't hit the high. And of course, we haven't even approached the February rate. So very similar to what's going on in every other market. So no changes there, nothing new, nothing interesting. But now it's time, and I can't get this guy to disappear. So we're just going to have to live with him. And I was using him to highlight stuff. And typically, you can click on X. So if you know the marker.to, there's a bit of a bug in the system. So, but it's okay. And the nice part is you can kind of highlight and have an ability to sort of showcase what's going on. But the Fed Powell, to speak, his focus turns from crisis to bond buying. So here we go. Let's take a look. And apparently it highlighted everything that is not what I wanted to do. I had it nicely highlighted what I wanted to do, but now it highlighted everything. So, gee, thanks. I don't know how I feel about this. Again, bugs in the system, bugs in the system. So, Federal Reserve Chair Jerome Powell will speak in a public webcast on Friday. So that's today. That's today, with details on the U.S. Central Bank coronavirus era program nearly complete and attention turning. Let's see if we can remove it. There we go. Uh, uh, with turning to the next phase of the response. They have been buying government bonds as mortgage backed securities to counter the economic fallout from the pandemic, but in relatively modest quantities, with what might be need to happen in order to keep the interest rates low. So there we go. This is one of those things that I've been saying. We haven't seen anything yet. We've only entered phase two. We're going to be seeing a whole lot more about that. So we've actually been doing, a lot more global investors have been doing stuff. However, I gotta kill this as well because this is silly. Uh, but the Fed is now going to have to step in to kind of keep that yield at the low level, and but they can't allow it to go negative, although it already has, although it probably will, and I still expect that the Fed might have to consider going into the negative interest rates, but I could be wrong, and I know they don't want to go negative. Right, I know they definitely don't want to go negative, but you never know what is going to happen with kind of where we go. What I do expect is that, of course, they're going to have to buy and print more money, and they're going to have to buy fallen angel, continue to buy that stuff. But now, basically, they're saying is that reopening process now seems to be moving much faster, quite fast, and likely faster than the Fed anticipated. So this is the vice chairman of the Everscore, a former New York Fed official, sent in the analysis on Thursday. He argues the central bank should not wait to begin setting expectations about long-term plans, since everybody else will. The Fed could best foster a recovery and support needed the government spending with strong commitment to maintain easy monetary conditions and guard against an unwanted increase in long-term interest rates. So the reason they need to keep interest rates low is because of the cost to finance, right? It's much easier for me to carry debt that is financed at 0% or 1% than it is something that is at like 10% or 20%, right? Because it accumulates. So this is the reason why they need to, because they've created such a large amount of debt that if the interest rate goes up, the country will have hard time turning that debt over and sort of kind of re-engage in it. So that's those are like the ways that you can, that you, the company, the country, everybody, it works exactly the same for everybody. You can pay it down, which I don't think the government is ever planning on paying the debt down. In this day and age of the inflation, and although we're not seeing inflation, we're still seeing deflation. That's what they're fighting, because that's the hard part when you have a lot of debt, is that debt burden becomes not something that you can sustain, right? It's sort of like if you have a lowered immune system and then you catch cold, that cold has a much stronger impact because your immune system is already lowered, versus if you have a strong immune system that can fight it off. You catch a cold, you don't even notice that you have it because your body fights it. It's similar with what happens with sort of debt when we have regular inflation, because everything is set for inflation. Our current monetary system is set up for inflation, not deflation. And so deflation is basically high amounts of debt is the lowered immune system, and debt is basically that cold that can turn very serious very fast, depending your how much debt you have, or how much your immune system is lowered or affected. And so, what they're trying to do is basically keep that inflation level on the not super high level, not super cold. It's sort of that Goldilocks, like we want it right over here. And they keep changing what the goalpost is. They used to say 6%, now they're saying 2%. Who knows what, why, and how. But the ways that you can actually deal with that is you can pay it off, you can roll it over, or default. right? Like that's it. Those are the only things that you can do. So the governments have been rolling it over for quite some time now, and so they need low interest rates and inflationary environment because inflation actually eats at that debt, eats at it. It also eats at your savings too, so it doesn't help in that regard. But if you are heavy on borrowing, inflation is actually very, very helpful in that regard. So the discussion is underway according to the minutes of the Fed's April 28, 29 policy meeting, but the officials don't see themselves rushing to clear because they want to see how quick or slow this recovery is, how quickly unemployment falls, what the interest rates do, and how they behave, because they might be able to set it, but all of the trading and all of the exchanges and stuff and people's supply, demand, and that kind of stuff, all of that sort of shifts what's going on. So that's basically what's happening. So the pandemic is, see, they highlighted everything. So now it's like I don't even know what I was going to cover. So we're going to cover it together now. But basically saying the pandemic is going to lead to a test of the notion that the demand of U.S. Treasury debt is infinite. We haven't even come anywhere close to testing the limits, but there's going to be a lot more sold. So they're basically saying, like we can print to infinity. We just don't know where that infinity is. And it's not necessarily, printing money is easy because it's not even printing. It's digital. It's digital. It's digital on a computer. Somebody somewhere gives authorization. Somebody, they sit and they go, boom, done. And so that's kind of how they print money. And of course, they can do it to infinity. You can create as large of a number as you want. But everything when it comes to money is confidence game. And once the people lose the confidence in the currency, that's where we actually start seeing some serious crashes and problems. So that's one of those things that you need to pay attention to it. I don't expect explicit, so this is where we are, in case you're wanting to read alongside with me. I don't expect explicit fiscal monetary cooperation unless the situation turns out to be extraordinarily bad. Um, Nonetheless, a commitment like the Bank of Japan to keep long-term government rates low should allow additional fiscal policy and something like that sort sort of communication by the Fed is not unlikely. So they're basically saying is that infinite printing, we're not going to stop anytime soon. And so, they're going to be rescuing everything and anything, which, if that actually does continue, at that stage, I do expect that the stock market will continue to go up. I mean, I know it sounds crazy. I know the economy is not doing that hot. I know we're going to have a lot of companies that are going to go into bankruptcies. Many of those are not even going to come back. And yet, overall, when you look at the stock market and stuff, I do expect with all of that stuff to keep climbing because the Fed is going to come in and rescue it. And so, it's this is not a financial advice, nor am I saying go in and buy it. I'm just sort of saying, looking at it, it makes perfect sense to me. And looking at it, I mean, I am personally excited because, as you know, I am personally in hard assets. So I'm personally predominantly in real estate. And so, I am excited because that means that I get to go in and get more properties and get some, super low financing. And we've already covered it that, rates are between, 2.5 and 3%, depending on your credit. And I actually kind of expect that to drop even lower if you can believe it. So, I mean, I will be very excited if I can get in, get some amazing cash flowing properties, and I'm able to buy it at a super low discount and then be able to finance it at like 1 to 2% for 30 years. I am set for life. And so I'm excited. I'm excited about all of that stuff. So, anyways, let's go in and finish with what's happening with the global tourism. One final sort of see, hydrate. Okay, let's talk. Global tourism facing worst decline on record. So remember how at the beginning of the show we were talking about 2 billion people losing jobs and getting out of, out of the employment and stuff, and that of course retail is going to be hit, which already has been. Airlines are suffering and will continue to suffer. Hotels, stays, and that kind of stuff will continue to suffer, which it has already. And so now we're saying, will tourism pick up? I mean, summer is around the corner. Italy, Spain, Greece, uh, you know, uh, um, all these countries that are located, and I'm talking about Europe just because I'm kind of familiar with that area, but even here in the United States, there's a lot of sort of beach property areas that they're, highlighting and saying, we're open, but I'm talking about countries in Europe because they still haven't opened their borders completely. And so they're saying June 15th, we are opening, you should come, it's going to be amazing. And so here we go. They're basically saying that international tourism is likely to shrink as much as 70% this year. That will make it the biggest fall in tourism since records began in 1950s. Secretary General of the U.S. Tourism Agency told the newspaper, I'm not even going to try to do this. I'm going to presume that this is somewhere in the either Scandinavian, German speaking countries, or Germanic speaking countries, let me correct myself, that the situation in the coronavirus hit sector could put 110 million jobs around the world at risk. He added that while international travel will suffer the unprecedented decline, tourist flows to rural areas may increase, setting a new trend for the next several years. People used to take vacations and they would go to places like Rome and Venice. And, while I still find those places to be beautiful, and I'm probably going to be traveling to those places. Maybe not this summer, but at some point in the future. Uh, but I think they're right. I think people are going to go remote. They're going to go into the woods, the forests. We might see a pickup of growing up. As you know, in Serbia we had this giant financial sort of fiasco of hyperinflation and all of that stuff. And I mean, talk about lack of tourism. We had lack of everything. Okay, no food, no heat, no. I mean, no was the word of the day. And money had no value whatsoever. So we had to switch over to hard currencies to kind of protect our wealth. Uh, but the ecotourism, I think it was called, where it was basically these farmers that had like, giant farms and maybe, like places where you can go camp and kind of stay with them. And so you would go and live and stay on the farm for a weekend, and, they would sort of, show you their cows and their cornfields, and you go like mushroom hunting. It's called mushroom hunting, I promise. Even though you're not really hunting, you're going searching for them, but it's called mushroom hunting. And that kind of stuff. And I kind of see that again becoming hip and picking up. And as you can see right here, June 15th is, tourism is sort of opening up, and they want. Greece is saying, come to Greece, and Italy is saying, come to Italy, and Spain is saying, you should come to Spain. It's going to be amazing. But again, they're basically not expecting vast majority of people to be traveling and to be going places, and so they're saying that the 70% drop is based on assumption that countries will begin to open their borders in August. Now, of course, this is inaccurate because we know that the countries will open borders much sooner. While European countries are easing lockdown, getting ready to reopen borders for holidaymakers this summer, other countries are not eager to follow suit when the virus is still not fully under control. While it may take some time before tourism is back on track, the UN agency chief signals that it might enjoy recovery soon. So I don't know. This is one of those things that is interesting. What do you think? What are your thoughts? Where do you sit with this whole thing? Is it going to reopen? Is it not? Are you planning to travel or not? Are you going to visit any large cities or going to the malls? Let me know in the comments. Let me know in the chat box. Let's find out of what's going on, because understanding of what other people are doing is what's going to help us all. So here we go. A bit shorter show for Friday. We've covered some stuff, and uh, I hope that this is helpful to you, and that as you are planning your next steps in business and investing, that you're understanding kind of where to go, what's going to happen. So if you've missed the show, watching the replay, that is awesome. Make sure you subscribe to that channel if you cannot join me live, but you should be joining live because we are going to be going live tomorrow at 7 a.m. And yes, I know it's a weekend, but you know what? World never sleeps. Money never sleeps. Investing never sleeps. So our education should never sleep. And so you got to study all the time, all the time, all the time. And so, yeah, we're going to go in. We're going to go in at 7 a.m. New York time, as they say. And we're going to be going live on onedealaway.com/live. I do want to do a quick shameless plug. If you haven't joined us for Crypto 101 course, it is absolutely free. We had a first live session yesterday. We went for entire 2 hours covering all kinds of cool things. And, I think people really enjoyed it. Again, nothing is being sold. My ultimate goal is to help you learn and to help you become a better educated individual when it comes to this brand new asset class so that you cannot be taken advantage of. That is very, very important to me. And all I want to do is give you my point of view, give you resources where you can go and search and learn on your own so that nobody ever can, take advantage of you and, of course, separate you and your money because that's what ends up happening, unfortunately, in today's world. So I invite you to join. Just go to onedealaway.com/crypto 101, and it's going to be in the description as well. I'm going to put it in the chat, and you'll be able to get go in, join us. We are actually going to go live on June 4th at 5:30 p.m. New York time, and we're actually going to be doing a smart session. And if you've never participated in the smart session, I invite you to come and participate. Again, I will put a link to that as well, and I look forward to seeing you there. Thank you for watching. Until next time, stay forever money blessed. And remember, you are only one deal away. Bye, y'all.